Imagine you're back in elementary school. There's a group of 5 kids who are the absolute smartest humans you've ever met. We're talking about the kids who finished the 100-question math test in 4 minutes while you're still struggling to sharpen your pencil. These guys don't just get A+, they win international awards. They have trophies for things you can't even pronounce. Now, imagine these 5 geniuses come up to you on the playground and say they've built a machine. This machine, they claim, can turn a single nickel into $100 every single time with 0 chance of failing. They've done the math. They've checked it twice. They have a certificate from the smartest professors in the world saying it's impossible for this machine to break. Would you give them your lunch money? Of course you would. Everyone did. In fact, the biggest banks in the world, the wealthiest people on the planet, and even some governments handed over their wallets. They thought they were investing in a sure thing. But what they didn't know was that these geniuses had accidentally built a financial doomsday clock. And in 1998, that clock hit 0, nearly dragging the entire global economy into a black hole from which there was no escape. This is the story of long-term capital management, or LTCM. It's a story about how the smartest people in the room became the biggest threat to the world, and how a perfect plan almost destroyed everything you own. To understand how this happened, we have to look at the men behind the curtain. These weren't just finance guys. These were the rock stars of mathematics. They included 2 men who had literally won the Nobel Prize for figuring out how to price risk. Imagine winning a Nobel Prize for being able to predict the future of money. That was them. They were joined by a legendary trader from the biggest investment bank on Wall Street. Together, they formed a sort of dream team of dollars. Their pitch was simple. The markets are messy, but math is clean. They believed that if you used enough data and enough computing power, you could find tiny mistakes in the way the world buys and sells things. They called this arbitrage, but you can just think of it as finding a penny on the sidewalk that nobody else noticed. If you find 1 penny, you're not rich. But if you build a machine that can find 1 billion pennies a second, you're the king of the world. And for the first few years, the machine worked perfectly. It didn't just work, it dominated. They were making returns of 40% a year. To put that in perspective, if you gave them $1,000, they'd give you back $1,400 in 12 months. They were the darlings of the financial world. They were so confident that they started telling their investors, "We don't need your money anymore. We have enough of our own." They were becoming so wealthy, so fast, that they started to believe their own myth. They believed that because they had the best equations, they were immune to the human side of money. They forgot that while math is logical, people are crazy. But here is the first twist. Even though they were making millions, their penny-picking strategy had a massive hidden flaw. To make those huge profits from tiny price differences, they couldn't just use their own money. They had to borrow, and they didn't just borrow a little bit. For every $1 of their own money, they borrowed $30 from other banks. Imagine you have $10 in your pocket, but you go to 30 different friends and convince each of them to lend you $10. Now you have $300. If you make a tiny profit on that $300, it looks like a massive profit compared to the $10 you started with. This is called leverage. It's like a magnifying glass for your money. If you're winning, the magnifying glass makes your wins look giant. But if you lose, the magnifying glass makes your losses look like a monster that can eat your entire house. The banks were more than happy to lend them the money. Why wouldn't they? These were the Nobel Prize winners. They were the no-risk guys. But as LTCM grew, they ran out of pennies to pick up. The market was getting efficient. So, they decided to do something dangerous. They started using their borrowed billions to bet on much bigger, much weirder things. They weren't just looking for pennies on the sidewalk anymore. They were betting on the direction of entire countries. They started betting on the interest rates of Italy, the bonds of Brazil, and the stability of Russia. They were no longer just mathematicians. They were gamblers playing with the world's credit card. And because they were so big, their bets started to move the markets themselves. They were the 800-pound gorilla in the room, and everyone else was trying to follow their lead. Then the second twist hit. While the geniuses were staring at their computer screens, something happened that wasn't in their equations. In 1998, Russia, a country that was supposed to be transitioning to a modern economy, suddenly announced it was broke. They decided they weren't going to pay back their debts. In the math world of LTCM, this was a black swan. It was an event so rare that their models said it should only happen once every trillion years. Their computers told them, "Don't worry, Russia will pay." But Russia didn't care about the computers. They had no money. Suddenly, the perfect machine started to smoke. Because LTCM had bet so much borrowed money on everything being normal, when things became abnormal, they started losing money at a terrifying rate. On one single day, they lost $500 million. That's $500 million gone in the time it takes to eat lunch. But it gets worse. Because they were so interconnected with every major bank, their failure wasn't just their problem. If LTCM went bankrupt, they wouldn't be able to pay back the billions they borrowed from the big banks. If those banks didn't get their money back, they might fail too. It was a chain reaction. A financial bomb was ticking, and the blast radius was the entire planet. Here is the third twist. You might think that in a situation like this, the geniuses would admit they were wrong and try to sell their bets to save what was left. But they couldn't. Because they had borrowed so much money and made such massive bets, there was no one left to buy from them. Everyone else was also panicking. It was like being in a crowded theater when someone yells, "Fire!" But LTCM was so big, they were blocking all the exit doors. They were trapped by their own size. The math that was supposed to protect them had become their prison. Their losses were mounting so fast that they were literally days away from having $0 left. If that happened, the stock market would have crashed harder than anyone had seen since the Great Depression. Every 401k, every savings account, and every pension fund was tied to the banks that were tied to LTCM. By September 1998, the situation was desperate. The head of the Federal Reserve, the people in charge of the U.S. money supply, realized that they couldn't just let LTCM fail, but they also couldn't use taxpayer money to bail out a bunch of wealthy mathematicians who had gambled and lost. It would be a political disaster. So they did something unprecedented. They called a secret meeting. They invited the CEOs of the 14 biggest banks in the world to a wood-paneled room in New York. They basically locked the doors and told them, "None of you are leaving until you agree to pay for this mess." This is the fourth twist. The government didn't pay a single cent to save LTCM. Instead, they forced the banks to buy the failing company. The Fed argued that if the banks didn't chip in $3.5 billion right now to keep LTCM afloat, those same banks would lose tens of billions when the market collapsed the next morning. It was a forced marriage. The banks hated LTCM, and they hated each other. But they hated losing all their money even more. They signed the papers, the money was moved, and the global economy was saved by the skin of its teeth. The dream team was fired. Their trophies were gathered up, and the geniuses went home with their reputations in tatters. The final twist, however, is the one that should keep you up at night. You would think that after almost breaking the world, the financial industry would have learned its lesson. You'd think they would have said, "Maybe we shouldn't use so much borrowed money," or "Maybe math can't predict everything." But that's not what happened. Instead, they saw that when things got really bad, the government would step in and organize a rescue. They learned that if you get too big to fail, you can take as many risks as you want, and someone will always be there to catch you. 10 years after the LTCM disaster, the world forgot the lesson entirely. The same banks that sat in that room in 1998 started making even bigger, even crazier bets on housing. They used the same kind of perfect math, and the same massive amounts of borrowed money. And in 2008, when that machine broke, there wasn't a room big enough to hold all the people who needed a bailout. The geniuses of LTCM were the pioneers of a new kind of danger. They proved that you can be the smartest person in the world, you can have the best computer, and you can have a Nobel Prize on your shelf. But the one thing you can never account for is the moment when the world stops making sense. When you build a machine to pick up pennies in front of a steamroller, you might get rich for a while. You might even feel like a god. But sooner or later, the steamroller speeds up. And as the men of long-term capital management found out, no matter how good your math is, the steamroller always wins.